Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
All right, let's talk about health savings accounts, or HSAs. A major new law just hit the books, and it completely changes the game. So if you're one of the millions of people who thought you couldn't get an HSA, you're going to want to stick around, because this could unlock one of the most powerful savings tools out there for you. I mean, maybe you've looked into this before, right? You checked your health plan, you read all the complicated rules, and the answer was just a flat, nope, sorry, you don't qualify. Well, all that might have just changed. That's because a brand new law has completely shaken up who is eligible for an HSA. So in this explainer, we're going to break down the 3 biggest changes, and more importantly, what it all means for you and your money. Okay, first, just a super quick refresher on why we're even talking about this. An HSA is, yes, a savings account for healthcare, but it is an absolute powerhouse. It's got this triple tax advantage. The money you put in is tax deductible, the money grows completely tax-free, and when you take it out for qualified medical bills, it's, you guessed it, also tax-free. It's an incredible tool, and that's why making it available to more people is such a huge deal. You know, for years, getting an HSA felt like trying to get into some exclusive club with a really tough bouncer at the door. The old rules were super rigid, lots of common health plans, common services, they just get you turned away. Well, this new law, it basically fired the bouncer and threw the doors wide open. So let's dive into the first big change, and this is one that affects pretty much everyone these days, telehealth. To really get this, we have to look back a little. Remember during the pandemic, a temporary rule was created to let people use telehealth before hitting their big deductible without messing up their HSA. But it was always temporary. Congress just kept extending it, kicking the can down the road. Well, no more. This new law finally makes that fix permanent. And here's the bottom line for you. All that uncertainty is over. You can have a video call with your doctor, and you don't have to worry that it's going to somehow disqualify you from putting money in your HSA. This is now a permanent feature of the system, which is fantastic. All right, let's move on to change number 2, because this one is an absolute blockbuster. It seriously expands the kinds of insurance plans that can be paired with an HSA. So if you're someone who gets your health insurance through the individual marketplace, from the Affordable Care Act, you really need to lean in for this part. This change is aimed squarely at you. The big question has always been, is my plan officially a high-deductible health plan, or HDHP? Because in the past, a lot of really popular plans just didn't pass the test. But now, here it is, plain and simple. The new law says that if you have a bronze plan or a catastrophic plan from the individual market, it is automatically considered HSA eligible. That's a huge deal, because it doesn't matter if the plan's specific deductibles wouldn't have met the old strict rules. Now they just count. One heads up though, this change generally doesn't apply to those small business shop plans. Now, here's a key date you've got to put on your calendar. This new rule for bronze and catastrophic plans doesn't kick in immediately. It applies for any month starting after the end of 2025. So as you start thinking about your coverage for 2026, this is absolutely critical info. Okay, let's get to our third and final major change. And this one tackles a really interesting and growing trend in healthcare. Direct primary care. So if you haven't heard of it, a direct primary care arrangement, or DPCA, is basically like a subscription model for your doctor. You pay a flat fee every month directly to their practice, and in return, you get access to a whole bunch of primary care services. So here was the roadblock. Under the old rules, the IRS looked at that monthly subscription and said, that looks like another health plan. And having other health coverage, even for just primary care, would block you from contributing to an HSA. It created this annoying conflict. Well, the new law fixes this with one simple move. It declares that a qualifying direct primary care arrangement is no longer considered a health plan when it comes to HSA rules. And that's the key that unlocks everything. It means you can now have your DPC membership for all your routine stuff and also have your high-deductible plan in your HSA for the big things. They can finally work together. But, and this is really important, there is a catch. For this to work, for the arrangement to qualify, that monthly fee you're paying can't be over a certain amount. So here's the first number you need to know. If it's just you, a single individual, the total monthly fee for that direct primary care plan cannot be more than $150. And if your plan covers more than one person, say you and your spouse or your whole family, that monthly cap gets doubled to $300. As long as you stay under those limits, you're in the clear to have an HSA. So, we've gone through a lot of detail. What's the bottom line? Let's just do a quick recap of who might have just won the HSA lottery. So let's run down the checklist. If you're someone who relies on telehealth, you're good. If you have a bronze or catastrophic plan from the marketplace, you're now in the game. If you're a member of a direct primary care service and your fees are under that cap, the door is now open. If any of these sound like you, it is absolutely time to take a second look at getting an HSA. And all of this leaves us with one final, pretty big question. For decades, we've thought of the 401k as the absolute cornerstone of saving for retirement. Now that these doors have been flung open, giving millions more people access to the HSA's triple tax power, you have to wonder, is the HSA about to become the new 401k for our healthcare and our financial future? It's going to be interesting to watch.